Our Market Monitor guest tonight has these words of advice for investors. Buy good quality stocks and stay away from risky investments. He's James Awad, chairman of Plimsoll Mark Capital. Jim, always a pleasure to have you on.
Thank you.
So you heard all of our reporting, all of these market records, Google hitting a record $1,000 price. What's your take on the market? Can it keep up this momentum, or are we getting into a dangerous territory?
Well, I agree with a lot of what Liz Ann said, but I would add that valuations are now fair, not cheap, that we are going to be revisit Washington in a few months, that at some point the Fed is going to begin the taper, and that there is speculation in the credit markets. Many people would say as bad as 2007 because the Fed has pushed people out the risk curve. So I think you can stay in, but you have to stay in with quality stories, with good balance sheets, and either good income or earnings stories.
You know, Jim, we began the broadcast tonight with a story about Google. Do you own it? Would you buy it? It was up 13% today.
Yeah, it's a very hard call. Look, I don't own it. If you wanted to own it and you had a 4 or 5 year outlook, I'm sure you could buy it and end up making money. But intuitively, it reminds me of Apple when Apple hit 700, that people tend to get overexcited. And most people who study the company have a value of about 880 to 1200. So it's about in the middle of that range. So if you didn't own it, you could buy half, but I would wait for a correction to buy the rest.
So you just mentioned Apple, and that's one of your recommendations for tonight. Let's talk about Apple. It's at $508 a share. It's been creeping back up. Why do you like it at this price? Okay,
so it's in the middle of a new product flow, many of which look exciting. It's got a tremendous amount of cash. Its valuation is not high, on roughly $45 of earnings next year. And some very smartest people in the industry are buying it. So I like the company of the people who are buying the stock. I'm not sure it'll get back to 700, but I'm not sure why it couldn't get to 600.
Let's talk about an old favorite, General Electric, which has not been on many people's buy lists for quite a while, but it's on yours right now.
Well, they are transforming the nature of the company, reducing finance, reducing media, and increasing infrastructure and industrial, which increases the margins and the growth rate. So you get a 3% dividend, and on $1.80 of earnings next year, I think the stock could go up 10%. So you could get maybe a 13% total return with good quality in GE.
And let's talk about Morgan Stanley, which reported earnings and doing very well. The stock has been climbing actually all year. As you look at this chart here, it's now at 29.69. What's attractive here? Well, again, here's a case where Mr. Gorman has dramatically changed the complexion of the company, lowering the high-risk, volatile parts of the business, increasing exposure to money management, asset management, which is high margin and stable. So the inherent profitability of the company is increasing, and it's got about a $27 tangible book, and estimates next year are for $265. So I could see the stock going up to 34 or so.
All right, let's take your last choice, which is not one I'm familiar with. TCP Capital, ticker TCPC. What do they do, and why do you like them?
Okay, so it's a business development corporation, which is related. Think of it conceptually as an REIT because they don't pay earnings. They pass it along to shareholders. So big banks are not lending much to small and medium-sized companies anymore because of regulation and capital constraints. And this business development corporation industry now replaces banks. And this is one of the highest quality ones. They have a wide variety of industries that they lend to high-quality, medium-sized companies. They sit on the top of the balance sheet with senior debt, variable rate. It's got almost a 9% yield. I met with the management this week. This is a quality 8.5%, 9% yielder, and I think and it's selling very close to book value. And I think they can grow the book value and the income stream over time. So it's not without risk. If you went into a 2008 kind of period, these kinds of stocks would not do well. But I think we're in a stable economic environment. So in the sweet spot that we're in, I think it'd be a good total return stock.
All right, sounds really good, Jim. Any disclosures to make?
Well, I own TCP for myself and my clients, and we own the Morgan Stanley and GE bonds for our clients and myself.
Thank you so much, Jim. Have a great weekend.
Thank you.
James Awad, chairman of Plimsoll Mark Capital.